So we sent out our November stats email. I want to talk you through some of it. Some of it's a little bit jargony from time to time, a little inside baseball. And I want to make sure everybody understands it. After that, there's a couple other pieces of data that I came across in the last 24 hours that I thought would be interesting. Okay, so first we're going to start with the average price. It's a little bit sluggish, kind of normal for this time of year. We're used to things coming down. We're going back into that normal seasonality, which we haven't seen really since 2019. I was super excited about this chart here. And that's because it's starting to show normal seasonality patterns. If we had the lines on here for 2020, 21, 22, it wouldn't be at all normal seasonality. So it seems like we are going back into that pattern. Really interesting to see the difference in pending units. I have a little bit more to say about that later, about 2023 versus 2008 pending units. And then this I thought was fascinating too. I really like this chart because people live in their monthly payment, right? How do you adjust for the prices coming down a little bit and the interest rates going up a lot, right? How do you normalize for that? And this chart is how you do that. This is the 5-county average monthly payment. It takes into account property taxes, pay down on the equity, the price of the house, right? And interest rates. So I love this chart for that reason. It is coming down, so the affordability is coming down a little bit. When affordability comes down, we will expect activity to pick up. That's one of the reasons why we watch that chart. So a couple other things I thought were really interesting. Interest rates are obviously big news since we sent this email out. Jay Powell came out and said that interest rates would not be rising anymore. They are committed to keeping inflation at their rate of 2%, but they are backing off the increase in rates. Bonds went, crazy after that, and rates came down to about 6.6 today, is where we're hearing that people are getting locked in, which is fantastic. Some mortgages where people are buying points, locking in around 6.2, 6.3. So that's incredible because in October we had hit 8% at one point. The other piece of data I came across that was really interesting is it was a comparison between the number of units, the number of resale homes in Austin in 2008 versus the number of resale homes now. So there is a 32% increase in the number of homes transacted from 2008 to now. And yet there was I wrote this down, 48% population growth. So if you normalize for population growth, the 2008 versus this 2023 transactions are actually down 33%. We had 33% fewer transactions than we would have expected based on our population growth. I think that's incredible. In some ways, it felt worse than 2008's people, and I guess it was. Now, we don't have those other structural issues, right? We had a lot of mortgages that were no-doc mortgages, et cetera, in 2008, and so there was this cascading effect. There was these bad assets, and then there's a lot of derivatives built on those bad assets. We just don't have that problem structurally in the market right now. I don't think it's going to be a V recovery by any means. We'll probably go sideways a little bit, but just really interesting data in the last couple of days. We wanted to make sure we shared that with you.